Hi, and welcome to Commodity Market Analysis. Today we're going to deal with technical analysis, and in this first part, we're going to look into the efficient market hypothesis. But first, we can look at some of the background for this lecture. And we're going to start with Chapter 6 in Carter, Futures and Option Markets. But we also have some very useful links for you if you have no or little experience with technical analysis from beforehand. But we also have the Robert Edwards and John McGee technical analysis of stock trends. This is almost the Bible for anyone who wants to do technical analysis. So, there are basically two methods for market analysis, and that would be the fundamental analysis and the technical analysis. And we're going to look into the differences between these two. And when it comes to technical analysis, we're going to look into what kind of assumptions you have to have in place for this to work. And we are going to look at the use of trend in technical analysis. This is really important. And we're going to look into support and resistance levels. We are also going to look into the importance of volume, because in technical analysis we only use price and volume. We're going to look into what kinds of charts we use, and we're going to identify some patterns which are usually found in charts. And in these charts, we're going to add some moving averages to try to detect trends, and we're going to calculate some indicators which will help us to maybe understand the market psychology of the price process. So, more specifically, what is the differences between fundamental and technical analysis? Well, fundamental analysis uses more data. It uses financial statements or financial data in general and economic data. And by using these data, you create a model to model the future cash flows of companies or any financial instrument, and you calculate by looking at these future cash flows the intrinsic value of the financial instrument. Okay, and in technical analysis, you basically use the price and volume because you assume that other market actors using fundamental analysis have processed their information and their data, and this information is reflected in the price and volume. Okay, and so technical analysis assumes that historical prices contain all information from supply and demand. This means that you can analyze any price and volume process. And for this to be useful, you have to look for patterns. And patterns only comes about if the price and volume process reacts in the same way over and over again. Okay? And to find these patterns, you use charts and you use indicators. And often you combine those. Um, the horizon of the technical analysis is usually short. It's often used to um, determine when to buy or when to sell, as opposed to the fundamental analysis. Um, it often uh, decides what to buy or what to sell. Okay, so what are we assuming? Well, we assume that all information, all data, and therefore all information is reflected in the price and volume. And if all information is reflected in the price and volume, then you do not need other factors because they would be redundant. So, and the second assumption is that price move in trends. Okay, so if the price did not have a memory, so to speak, uh, then the technical analysis would be futile because you would not be able to identify patterns and use those patterns again and again. So what we're saying is that history repeats itself. If it didn't, then we would just be guessing. And why does it repeat itself? Well, it does not have anything to do with innovation or any of the traditional economic factors, but human psychology. And to forecast human to forecast human behavior is really difficult on the individual level. But if you look at the aggregate level, human psychology is actually quite forecastable. And this is why we assume that technical analysis actually works. However, um, technical analysis uh, it doesn't come without criticism, and one of the uh, most well-known and adapted um, theories in finance and economics is the efficient market hypothesis, and this is that all prices reflect all information possible. If even one investor has information, then the price should reflect that information. And this um, this includes information from technical analysis itself. So if anyone finds a pattern in the chart or with indicators, then in the future, this pattern should be unprofitable. But the efficient market hypothesis does not come without criticism itself, because if you look at all investors in the market, uh, everyone has different data, and everyone processes this data into different information sets. And this means that every single individual has a different experience and interprets the data differently. Okay, so that's why you can look at, for example, analysts, and even though they basically have the same information set, they produce vastly different estimates. So what can we do? We have the efficient market hypothesis, and as economists, we want to test it. And this means that we test the random walk theory. And the random walk theory says that historic or historical price moves do not contain information about future price moves, which means that you can't use historic data to forecast the future. And this is actually one of the best tested theories in economics, um, mainly on stock prices. Stock prices. Um, so, what's our problem? Our problem is that um, we can't perform an experiment. We only have historical data to work with. So what we're going to do now is that we are going to devise some tests to actually test the random walk theory. So, if you have a random walk, then you would not be able to forecast the pattern, okay? Because there would be no pattern. The process would not repeat itself. And to test this, you can look at whether you can forecast the next price move. So even if you could forecast the price move to a small extent, then that would actually falsify the random walk hypothesis. So to start with, you could just look at the graph of the stock price. And if you look at the stock price, and actually if you look at the stock price at any increment, like monthly, weekly, daily, hourly, or per minute, you would see that the stock price is quite jagged. And if you look at the random walk process, it's quite jagged. And if you would have a smooth graph, then you would be able to predict where the price would move in the future. So if the graph were smooth, then you would actually be able to identify a trend. So that was a visual test. What you could do is that you could take the correlation of the price return on time t with the price return at t minus 1. If there is a correlation between the price changes, then there would be a possibility for forecasting. And if you have a non-zero correlation, you could actually use this information to forecast the future stock price change and make an economic profit. So what you do is that you calculate the sample correlation for the price changes, the price returns. Okay, so if this correlation is vastly different from zero and statistically significant, then you would infer that the random walk theory is falsified. And if the sample correlation is close to zero, then you cannot falsify the random walk hypothesis. So if your null hypothesis is that the correlation should be zero, then you can actually assume that the correlation, the sample correlation, is distributed as a normal distribution around zero. And the standard deviation of this sample correlation is easily calculated as 1 divided by the square root of the number of observations. Okay, so this enables you to make a confidence interval. So if you take around 0 plus 1.96 times the standard deviation, that would be the high end of the confidence interval, and you take the negative 1.96 times the standard deviation, that would be the lower bound of the confidence interval. Then you can say that in 95% of all instances, the sample correlation you find would lie within these bounds, which means that if you find a sample correlation which is outside of these bounds, then you would falsify the hypothesis. Okay, so the critical value is plus minus 1.96 divided by the square root of n. So you see that if n increases, then the bounds will decrease towards 0. So you would reject the random walk if the sample correlation lies away from 0 by more than this critical value. Okay? But we need to have a word of caution, because if your number of observation is high, then even a small correlation from deviation from 0 would be significant, even if it would not be economically significant. So that was the correlation test. We also have the runs test. Okay, and a run is a sequence of days in which the price changes in the same direction. So in our small data sample here, we have 14 observations, and for the first 3 observations, the price move is positive. Okay, so this is a run. And then there is a negative price move. That is a different run. And then there is a positive price move. That would be another run. Okay? And the 5 price moves thereafter would be one run. Okay? So here the plus sign is that the price goes up. The negative sign is that the price drops. And so here we have 14 observations and we have 5 runs. The question is, how many runs do we expect? So this means that according to theory, what we would expect is a number of run of n divided by 2, n being the number of observations. And why is this? Well, we have the fact that if you have a price move one day, the price move of the next day is the same with a probability of half, and it's different with a probability of half. So the probability that the run continues is 1/2. So if you look at technical analysis, we assume that we have momentum, which means that price moves in one direction tend to follow each other. So the trend continues. So this this means that we can calculate the number of runs in our data, and we can calculate the expected number of runs, which is the number of observations divided by 2, and we have the standard deviation of the number of runs, which is the square root of n divided by 2. So if we look at if we look at the hypothesis that our number of runs are fewer because we have this momentum, then we can test this number of runs that we found with the expected number of runs and the confidence interval in one direction from this number. So what we are checking is that our number of runs is less than 1.64 standard deviations below the expected value, and the expected value is n divided by 2. So if our number of runs is below this number, then we falsify the hypothesis of the random walk theory. And here we have an example. So if you have 100 data points, then the expected number of runs is 100 divided by 2, which is 50. So the standard deviation of runs is 100, which is your data points, the square root of 100 divided by 2, which is 5. And so the lower bound of the confidence interval for the one-sided test is 50 minus the standard deviation, which is 5, gives you 45. So if your data process contains less than 45 runs, then you will reject the random walk for that data. The last test we're going through is probably the most interesting one, and that's the trading rule test. So if you can devise any trading rule that generates an economic profit from this price process again and again, then you're in effect falsifying the market efficiency hypothesis. So if you can make an abnormal profit from being in the market and applying your trading rule, then you're falsifying the hypothesis.